In this video, we're going to talk about three-dimensional risk management and how it can help you no matter what you're investing or trading in, be it stocks, Forex, commodities, crypto, or anything else. The central focus of three-dimensional risk management is Rule 603, Synchronization Profits. When you are synchronized, you make profits, and when you're desynchronized, you pay the market. Let's run the numbers. There's a massive difference between retail traders and investors and professional traders and investors. Retail are emotionally driven. Professionals are synchronization driven. Synchronization results in profits and desynchronization results in losses. Professionals know Rule 446, all markets are intercorrelated and interdependent. Retail traders and investors are only interested and therefore only focus on the charts that they're putting money into. Professionals are completely different. They understand the market pulse. They understand objective dynamic market structure, or where smart money is buying and selling. And then they deal with price reality, not reason indicative price or story-based analysis. The two ways of investing and trading from retail to professional are light years apart. The central focus of three-dimensional risk management is you control the trade or investment, but the market controls the return. Your returns are always based on your active learning, your knowledge, and your courage. The market penalizes blame and gambling. To do three-dimensional risk management, we must understand that price is always moving in a wave. It can go down, it can go neutral, or it can go up in any specific period of time. The focus is to raise the synchronization score. The synchronization score is your profitability score. The first thing to understand, there are three different tiers of charts, and all charts are intercorrelated and interconnected. The Tier 1 charts are the engine of financial markets globally. If the engine starts to splutter, you can be assured that whatever you're trading or investing in will start to nosedive. Today, I'm going to show you how to practically apply three-dimensional risk management to Tier 1, Tier 2, and Tier 3 charts. Three-dimensional risk management curves go in three dimensions: up, neutral, and down. They are all based on the output of the CTKS method. To create three-dimensional risk management paths requires Level 1 certification and Level 2 certification of the CTKS method. Level 1 certification gives you all the foundations that are required to apply the CTKS method. Level 2 standard certification is where all the magic occurs. You can see that to apply the CTKS method is not that simple. That's why the CTKS method monthly service was created. Level 1 standard certification gives you the foundations. Level 2 gives you all the rest. Hence, this particular line, this positive line drawn on oil, uses the CTKS method as its underpinning structure. It is not a random line. Also, the thing to note, this line was drawn at the start of the month. It's not drawn right now. Three-dimensional risk management curves are not adjusted either. Masterclass students, an LV video will be coming out in the next week on how to create three-dimensional risk management curves. The purpose of a three-dimensional risk management curve is not to predict price, it's to predict direction. For example, when we looked at the S&P 500, it was at the start of the month following a negative price curve. It's gone to neutral. This shows an improving market. As all charts are intercorrelated and interconnected, we can see the NASDAQ composite index had more power than the S&P 500. It came down, certainly, but it's come back and is following a consolidation case at the moment. The important thing to note, it's not going highly negative. Knowing where the markets are actually going is incredibly important for synchronization. Without synchronization, you cannot profit. To boost synchronization, we focus on price reality as professionals and do our three-dimensional risk management. All charts and markets are intercorrelated and interconnected. When we pop across to crypto, we can see that Bitcoin initially was following a consolidation case, had a bit of a scare with FTX, but is now going positive. It's leaving the consolidation case and heading towards the positive case. Many people inside the crypto market do not see the requirement to look at the main markets. This is a huge mistake. Professionals always look to the main market first. Even though Bitcoin largely consolidated, this positive momentum inside the S&P 500 and the NASDAQ is driving risk-on behavior across the markets. That is filtering into crypto. The market rewards active learning. That is when you actually look at something deeply and say, how can this affect what I'm doing? We saw that the NASDAQ came down and then is going up. It's left for now this negative price curve. That's very, very good, and that's being reflected inside crypto. What about if it went the other way for an active learning exercise? This will help you gain a deeper appreciation of how charts are intercorrelated and interconnected. Say the index went up and then down. How do you think that may have impacted crypto? We have an incredible global family. We're a global family of learners. I look forward to your comments. If you're inside the stock market, perhaps investing in Apple, how the major index goes is how the sub-stocks go. And Apple is a very key stock. We can see, even though the NASDAQ and the S&P 500 are going largely positive, Apple is under duress. It's continuing to follow the negative path. If we didn't have this three-dimensional risk management, we might look at Apple like this and say, oh, it's okay, everything is pretty fine. But the truth is, Apple is following a negative three-dimensional risk management path. Do three-dimensional risk management curves also apply to Forex? Yes, they do. We can see here the euro dollar is following the negative price curve. That must mean the DXY is following the positive price curve. All charts are intercorrelated and interconnected, but let's prove it. We can see exactly that. The DXY is following the positive price curve. The DXY has significant impacts, especially on commodities. The key question, how do you apply three-dimensional risk management curves to your trades and investing strategies? If we look at the US 10-year yield, we can see that it was following the positive path. It's starting to weaken. That's exactly why the S&P 500, the NASDAQ, Bitcoin, total crypto market cap are starting to turn around. What we want to see is the US 10-year yield and the 2-year start to come down. The DXY coming down would be a bonus as well. As price is always moving in a wave and our brains think from a linear perspective, if we don't account for the wave motion inside price, we'll continually get desynchronized and make losses. No matter what market you're in, it's very important to look at the Forex pairs. Here we're looking at dollar-yen. We can see that it was following a positive price path, but now it's shifted. It went down to consolidation, and now it's showing a degree of positive price momentum. This can be reflected back onto the DXY, and also the US 2-year and the US 10-year yields, which are vitally important to understanding how the S&P 500, the NASDAQ, the Dow, the Russell 2000, Bitcoin, total crypto market cap, how they will move. Rising yields and a rising DXY put negative price momentum on commodities, and here we can see silver following the negative price path. But if things start to turn around, if we see dollar weakness and yield weakness, silver and gold will rally. By having three-dimensional risk management first and foremost in your mind and looking at how price reality actually unfolds inside the charts, you don't get sucked into the retail way of thinking, having story-based analysis, only looking at recent price and only looking at the charts you trade, not looking at the market pulse and the market structure. Retail is by definition fundamentally desynchronized. Professionals are synchronized. We can see that gold has been largely following the negative price path, but it's starting to consolidate out. If we see a drop in yields, a drop in the DXY, and that will be reflected in the Forex pairs. And also other Tier 1, Tier 2, and Tier 3 charts, gold could do really well. However, if inflation persists, gold, silver, commodities will get hit. If you were investing and trading in gold, but you didn't see gold following the positive price path, you saw it following the neutral path at the start of the month, but then coming more and more negative as time progressed, you can make appropriate decisions based on that information, and knowing the price paths at the start of the month is very, very powerful. The key is professionals don't guess. What about economic health? When we look at copper was deeply going negative and just turned around in the nick of time. It's starting to go under a consolidation case. This is very good for global markets. Dr. Copper is something to watch out for. Another thing to note is how the growth stocks react to positive momentum, and we can see Tesla was going negative like the majority of the market, but when things started to turn around, Tesla is soaring. This is why it's so important to look at so many different charts. Retail is never taught to do this. This is why retail loses so much money. Market structure is incredibly important to understand. When there's market structure working against a chart, that price will be suppressed. And we can see price suppression on Nvidia, and this is largely due to market structure. Market structure is revealed through the CTKS method. All markets are intercorrelated and interconnected. Here we see total crypto market cap hit by the FTX saga, but just shrugged off and ignored. Why is that? Because the main markets are starting to repair. You might say, Ken, why would I bother looking at total crypto market cap? Because every single crypto is included in total crypto market cap. Your little alt, and it could be just anywhere in the top 1,000 or even beyond that, is impacted by this directional move of total crypto market cap. It's critical to look at. But to understand where total crypto market cap is going, we need to understand the Tier 1, Tier 2 charts as well. When we're looking at Solana started on a positive price path. If you know the three-dimensional risk management path, it's very hard to get desynchronized, because you just look at the path and say, well, Solana is not following the positive path. It's gone neutral. And when the FTX saga came out, it went negative, but it's since starting to repair itself. When looking at Ethereum's three-dimensional risk management curves, we saw it was largely following a consolidation case, then went very negative as retail just utterly panicked about the FTX liquidations. It's since recovered and it's back to a consolidation case. Bitcoin Cash was following the consolidation case, had a bit of a dip down due to FTX, but has now gone positive. This gives you an understanding of the strength of Bitcoin Cash relative to other cryptos. The key to remember, a three-dimensional risk management path is only formed in relationship to CTKS structure. That is where smart money is buying and selling, and you can see here that BNB reached a very dangerous point. It lost a level of structure, and that's why it came down so fast, and that's exactly why the negative curve is pointing down like this. Fortunately, BNB recovered. But why did it recover? Because total crypto market cap and Bitcoin recovered, and also the indices recovered. When looking at three-dimensional risk management, it's all about understanding what would you do if price goes for you, against you, or goes nowhere. The three-dimensional risk management paths are drawn out on Tier 1, Tier 2, and Tier 3 charts inside the service, and there's a video that explains each chart and how price is interacting with structure. Every month, the three-dimensional risk management path will change. We can see ADA just had a little bit of a drop down, but it's largely following the consolidation case. Professionals do not engage in story-based analysis, they engage in price reality. If you were investing or trading in XRP and you were assuming a positive case scenario, you would be desynchronized because it went on a consolidation case and then went negative. We've seen a broad base increase in the crypto market through total crypto market cap and Bitcoin, but this would have pushed a lot of people out of synchronization. Let's have a look at Litecoin, and to increase your synchronization, please note that when you get a very strong reaction inside the market, you can use that to determine the strength of what you're looking at. We can see that Litecoin had a very strong reaction to that FTX news, but it had a very strong reaction to the fact that the markets are all starting to come up. Professionals know that all markets and therefore charts are intercorrelated and interdependent. If they're focused on something, they make sure they focus on the Tier 1, Tier 2 and Tier 3 charts before they place their trades or investments. The three-dimensional risk management paths that I showed you for the Tier 1, Tier 2 and Tier 3 charts are represented inside the service. They are actually from the service, but the difference is that service just projects those curves out to the end of the month. Therefore, when you look at the service, you'll see projections for the next 14 days out. Price is always moving in a wave. That means the price can go down in an uptrend and up in a downtrend. This is why doing three-dimensional risk management is really important. Looking across the Tier 1, Tier 2 and Tier 3 charts is vital. More so, understanding where the structure is, because if you don't understand objective dynamic market structure, which was invented via the CTKS method, it's just impossible to figure out where price would go. Those three-dimensional risk management curves are not guesses, they're based on market structure and a probabilistic move in prices. The unfortunate thing, retail is consistently desynchronized and therefore non-profitable because they do not look at the market pulse. They don't even understand Tier 1, Tier 2 and Tier 3 charts. They do not understand CTKS structure. They ignore price reality. Instead, they focused on story-based analysis. They only focus on recent indicative price and just a handful of charts. They don't do three-dimensional risk management. To become consistently profitable does require work. Djokovic is the #1 tennis player in the world. His prize money, all-time leader in earnings, is in excess of $175 million US. People know that champions need to train. Champions work hard, they train hard, and they have the best coaches. Djokovic didn't start as the world #1, he worked his way towards it. All professionals need to start at the bottom rung and work their way up. When it comes to financial markets, it's no different. You must start at the bottom rung and work your way upwards. How much effort, energy, dedication and commitment you put in to your training will determine how far you go. Everybody would know that if you wanted to become the #1 tennis player in the world, you're going to have to work really hard to get there. There are no shortcuts to success. You must put in the work. Unfortunately, inside financial markets, there are a lot of scammers out there that just say you don't need to do anything, you don't need to know anything, and you become world #1. What a lot of rubbish. To become elite in any sport or endeavor, you need to put in massive amounts of work. There are no shortcuts. It's exactly the same with financial markets. You must know what you're doing. To gain financial freedom, which is the value of investing and trading inside financial markets, you must pay the price. Anybody who says you don't need to pay a price is like saying you can become the world's #1 tennis player with absolutely no work and no experience. The first step on the path to leaving retail trading and investing is to know that all the charts depend on each other. They just measure risk differently. When you understand the Tier 1, Tier 2, 3 charts, you understand how they're moving and what they mean. You will start to get more and more synchronized, and this will take time. This is not instant. Thinking in terms of three-dimensional risk management is really important. Know what you will do if the price goes up, goes down, or goes nowhere. And always remember, the great become great because they do a great amount of work, and they're greatly committed, and they greatly persevere. They keep a positive mental outlook and attitude because they need to, because they'll get setbacks along the path. Those setbacks are set-ups. They just make you stronger. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.